understanding, number one, that most insurance policies and most clients are completely underinsured when it comes to calculating that correct replacement cost is a big factor. And then number two, what is the definition of your policy's replacement cost? So if it were to cost more, I also learned from Chubb recently that over 70% of homes that have a total loss, the payout to rebuild is more than what's listed on the policy. So having that buffer is key.
Welcome, everybody, to our webinar, Navigating Uncertainty, the Evolving Landscape of High Net Worth Insurance Protection. I'm Charity Partners Chief Solutions Officer Tom Cohn, and I will be moderating this great panel on what is an important and critical topic. The wildfires in LA this year really highlighted the importance of having a proactive risk management strategy in place for many of our clients. With the ongoing stresses that are happening, not only in the property and casualty market, but across the insurance industry, it is really important for our clients to understand all the nuances and all the trends going on within the insurance market and how we can help them protect their assets, which are critical. And so I'm very excited to have an expert panel today of speakers with our partners at Brunswick Private Client and Chubb Insurance to help us unpack and answer those questions. Before we dive into the topics, I want to introduce our speakers today. Michelle Hirsch from Brunswick Client. Michelle has over 15 years of experience managing Brunswick, including the operations, marketing, and really working with individual clients to make sure that they have their risk management needs met. Thank you, Michelle, for joining us today. Also with us from Chubb, Elise Smith. Elise has over 32 years of experience, including 28 of those with Chubb, working with insurance professionals to come up with a comprehensive plan for families and individuals to meet their personal insurance needs. Thank you, Elise, for joining us. And finally, Melissa Meisenbacher joins us from Chubb as well. She has 19 years of experience in insurance and claims management, spending 9 years with Chubb, and she currently serves as a personal lines claim executive where she works with individual clients to make sure their needs are met. So thank you, Melissa, for joining us as well. Today, we're going to cover three things on our agenda. I want to talk about the important market trends going on within the insurance industry. I want to talk about the changing marketplace and what are the factors and variables that are driving decisions around who can get insurance, where they can get insurance, and answer an important question. Why can't I get insurance, or why can't I get the right amount of coverage to meet my risk needs? And then finally, we want to talk about what do you do about all this? And how can you make sure that you're properly covered? What are the things that each of us should be doing to make sure that we have the proper property coverage, casualty coverage, or umbrella coverage? What are the key considerations that we should do, and what are steps that we can take to be proactive ahead of any type of event? With that, I am going to pass it over to Melissa to talk about the key trends going on in the insurance market in 2025.
Thanks, Tom. So let's go ahead and dive into what changes we're seeing within the marketplace and product lines. First of all, with luxury home values, we are seeing that this market continues to grow. And with that comes the need for more high net worth homeowner coverages. Currently, about 9% of all homes within the United States are valued over $1 million. Moving from the value of the home to some of the factors that influence the replacement cost, the average hourly wage of residential building workers continues to increase. According to the National Association of Home Builders, year-over-year growth rates over the past 4 months have been unprecedented. So that's the bad news. Better news is that material costs are stabilizing for now. You'll recall, we've seen substantial material costs increases over the past couple of years. On this slide, you can see that we've returned to more normal year-over-year increases. However, it's taking longer to complete new construction. In many places, the time it takes to secure permits is increasing, especially in New York, Washington, D.C., Illinois, and we're definitely going to be seeing that in California as well. At this time, the costs of complying to building codes, which often make up 25% of the price of new construction, along with a shortage of qualified labor, you can see why the cost of construction continues to rise. Just to call out a few, we're seeing concrete products rise at 5%. Some of these numbers are pretty interesting and eye-opening as well. And with the overall material costs, while they've been stabilizing, it's important to consider the impact of the major natural disaster and the impact that it has on supply and demand for new construction as well as renovation. Using the California wildfires as an example, let's look specifically at lumber costs. Based on a recent article published in the LA Times, there will be roughly 10,000 homes that need to be rebuilt in the footprint of the Palisades and Eaton fires. Lumber is the biggest component of the home building materials, and experts are already estimating the lumber prices could jump anywhere from 25 to 40%. This doesn't even contemplate the additional cost of lumber as a result of new tariffs. As an aside, we're obviously watching the tariff situation closely to determine what impact they will have on our overall cost of claims. And with that, I'll go ahead and pass things over to Elise, who's going to talk about other weather trends.
Thank you, Melissa. And yes, we will look at the weather trend next. So let's dive into what shaped weather in 2024. So 2024 was ranked second for the total number of billion-dollar industry events, and there were 27 of them. The year ranked fourth in the total annual cost of these disasters, costing the industry $183 billion this year. So just remember, these are billion-dollar events for the industry, and there were 27 of them. Think about how many events happened that were not at $1 billion. And if you look over the past 6 years, one would think hurricanes were the highest economic loss. But actually, the frequency, which 65% of the events, so 89 out of 137, came from convective storms. So this next slide, this just gives you a visual. It takes those $27 billion events and put them on a map of where they occurred. So as you can see, there is a large cluster of events in the Midwest. We've updated this slide over the past 6 or 7 years, and in some years you're going to see more on the West Coast and more on the East Coast. But even over the past few years that we've updated this, the largest cluster has really always been in the Midwest. Now, if you really look at the graph closely, you might ask me, where's the flooding in North Carolina? We don't see a little flood symbol there. And that's because the National Oceanic and Atmospheric Administration actually classified that as a hurricane, Hurricane Helene. And then I want to point out on the right side, again, this has broken out the 27 events by what caused them. And again, 17 of these were severe storm events. So speaking of severe convective storms, these are defined as a collective name for severe thunderstorms, including heavy rainfall, strong winds, hails, and tornadoes. Hail is the largest type of damage produced by convective storms, followed by wind, tornadoes, and then lightning. So then this next graph provides you with a good visual of how severe convective storms had increased in the United States over the past 10 years. You can see starting in 2021, there was a significant jump in the cost associated with these storms. Unfortunately, this is probably a trend that is here to stay for the near future. So insurance companies will have to look at collecting more adequate rate and sometimes contract changes like wind and hail deductibles. And now I will pass it back to Melissa.
Thanks, Elise. Another risk that continues to rise is flooding. Many places are no longer immune to flood losses, as we saw in the North Carolina mountains last year. In 2024, FEMA declared at least 45 flood-related major disasters. And per the NFIP, 90% of all natural disasters in the United States involve flooding. This map shows the percentage of homes with flood insurance per the NFIP. The red and orange areas show the geographies where less than 2% of the homes have flood coverage, while the bright green areas are geographies where over 10% of the homes have flood coverage. 2024 had more flash flood emergencies than any other year, and you can see those numbers underscore a troubling trend as they've been steadily on the rise over the past 10 years. This is another important coverage area to understand and review with your clients. Here are a few examples of when the National Weather Service issued a flash flood emergency. When you think about 6.5 inches of rainfall in the first example in Illinois that occurred from late Saturday into Sunday morning, you know it can have some devastating effects. And then look at those numbers in Connecticut on August 18th. 14.83 inches of rain in just under 24 hours. I can only imagine the impact that amount of rainfall had on the area. With that, I'm going to go ahead and hand things back over to Elise, who will talk to us about the excess and surplus market.
Thanks, Melissa. So, when we think about the ways the insurance industry has changed over the past few years, probably the most significant change has been the use of the excess and surplus market. This is sometimes referred to excess and surplus lines, E&S, or not admitted. The vast majority of personal lines insurance is written in the admitted market. The admitted market is, you could look at as a more of a regulated solution. So if a company desires to change their pricing or the terms of their contract in admitted, they have to file those with the state. So there's a big actuarial team that's involved, filing with the state. A lot of time there's back and forth, there's questions. And in many cases, the state actually has to approve the changes. The E&S market allows a company to price more appropriately for a specific risk and offer terms that allows the company to be more comfortable taking on the exposure. So this slide here really shows that in the last 10 years, the E&S industry for homeowners written premiums has tripled in size, with the most significant increases coming from 2021 until today. We do expect this trend to continue. The spike was driven by companies not being able to take the rate they needed or offer terms in the admitted market, coupled with a significant increase in reinsurance cost and reduction in capacity provided by the reinsurance carriers to the insurance companies. So many times this is actually a tool that a carrier uses so that they can remain a viable solution in some states. It's a tool they can use to offer different terms, such as maybe limited water backup coverage, limited interior water damage, claims from pipes, higher wildfire or hurricane deductibles, or just the use of sublimit from certain perils. So this slide shows that Florida, California, and South Carolina top the list in terms of direct written premiums for E&S homeowners across the industry. And really, it's, as I said before, there's things that can be changed. So it's not really just for coastal states. And again, sometimes it's an insured may elect to go into the E&S so that they can take on more reinsurance. If someone had a $20 million home in Florida, because of the newer construction, they may decide, I really only want to purchase $5 or $10 million in hurricane coverage versus that 20-minute limit. And the E&S is a tool to allow them to look at that. And now I will turn it over to Michelle.
Thank you, Elise. So all that's being said, it's an understandable situation as to why we can't get insurance between all of the natural disasters and the shift between non-admitted and admitted marketing. There's a lot of angst out there. People are getting non-renewed after they've been with the same carrier for decades. The saying, it's not you, it's me, is really relevant here because it may not have anything to do with you and you've been claims free. It may just be that the insurance company is looking at their loss ratios and figuring out how to remain profitable in that zip code. So it could be based off of who or where you live, but it could be just truly the insurance company's profitability. So what this means for you is to just really get out ahead and understand your broker should know that you're getting non-renewed before you do. Having them be proactive to have those conversations and sit down and understand what your options are, what the timeline looks like is really important so that you're not scrambling at the end and that you understand all the implications of what this change is going to look like. And when the traditional insurance option is no longer an option, having that non-admitted insurance option to understand what the differences are, the pricing implications, the coverage changes, and having someone help you walk you through it, it just makes the transition a whole lot easier. The non-admitted market used to be something that was a little scary or something that people didn't want to be in. Now it's actually a great solution because many of the high net worth carriers are playing in this space. So you still get the high net worth experience of their adjusters, you still have their financial security, and you still have the ability to know that you have a concierge high level situation, even though you may not be in that non-admitted or in the admitted space anymore. Again, location is everything, and certain zip codes, depending on the day, would be open or not open. The capacity of the insurance carriers changes daily, literally, especially out in California. And so what we're seeing is, depending on where you're located and your risk profile, it could be your elevation, how far you are from a fire department, the characteristics of the home. Do you have a wood roof? Is there wood siding? Is there brush around the property? The landscaping situation. How high up is the property? What flood zone are you in? And then also the personal circumstances. If a client has a claims history or a challenging driving record, or maybe they need special types of coverages like very high umbrella limits, all of these things could make you at risk for either a non-renewal or being pushed into a non-admitted option. It's just really understanding it so that you understand the why, not just frantically freaking out in the last moments. So the difference is, and Elise mentioned this, the non-admitted carriers do not have to file with the state. Their coverages, their underwriting guidelines, their pricing, that also means that they are not necessarily backed by the state. So having a carrier that has that financial security is very important. There are many non-admitted carriers out there that are popping up to take advantage of the situation, that often many of our clients have a better financial backing than these carriers. So understanding the who is playing in this space and will they be there when the loss is there to be able to pay out is very important. Understanding the claims experience when you do have the claim in these non-admitted spaces. Some of these claims adjusters, it's very bare bones coverage, and it's also very challenging when it comes to a claim to be able to get the proper payouts, to understand what is coming your way, what options are available to you, and it can be very aggravating in that moment of distress to be able to have to work with an adjuster that is making it a very challenging process. And then the cost, it's going to cost more. Non-admitted options, because they have the flexibility and the creativity to do creative things with their policies, that's when they also have the creativity to adjust their pricing. But we see a lot of clients out there who are willingly and happily paying more with a high net worth carrier non-admitted product, as opposed to a carrier out there that they know is not financially secure or the claim experience is not going to be great. You get what you pay for in this world, and they want to know that they have peace of mind. And then lastly, there's a lot of things that you can do to either be proactive or perhaps try to make the home not necessarily be a non-admitted option, perhaps to be able to stay in that admitted space, but also just as a good and sensible homeowner, be able to protect your home. So whether it's installing the different alarm systems monitored by a third party, burglar, fire, low temperature, we don't want those pipes to freeze. The automatic water shutoff devices have become extremely high tech, tied to that main water line. And if they recognize that your flow is more than typical, it will automatically shut off the water line. Has saved millions of dollars in claims and their payouts. Just understanding the security of the home, the true nature of what you can do, whether it's clearing brush or different landscaping ideas. And the high net worth carriers are there to help. Because many of them will visit the properties, they'll provide those suggestions, as well as vendors who can install and or monitor these different types of risk prevention tools. When we talk about key coverage considerations for even our clients who don't have a problem getting insurance, but we want to make sure they're with the right carrier. So no two insurance carriers are the same. No two insurance policies are the same. Every carrier could have a different endorsement. The 100 pages in the back of the small print that no one likes to read, it really has different definitions of all of the coverages. And the difference between a middle market carrier and a high net worth carrier can be vast. The statistic is that 70%, and this was a Chubb statistic, so thank you to our Chubb partners, that 70% of high net worth eligible individuals and families are not with a high net worth carrier. So many of these bells and whistles that I'm about to talk about may or may not be something that you already have in the 100 pages in the back that's built into your policies. So having an independent broker do that review and really get in there to understand what you have is really important. When it comes to homeowners insurance, the first thing to really understand is, what is your home going to be replaced for? What is that value amount? The high net worth carriers will put your address and the makeup of your home into their replacement cost estimator system. And they will say, if the house burns to the ground or blows away, how much would it cost to wipe away all the rubble, redo the foundation, and rebuild this house to the exact same specs with brand new construction? That's the amount that's listed on the policy. That number is important, but what's really important is at the time of the loss, if that number is more. For the exact same square footage, the exact same amount, what happens? Do you come out of pocket? Does the insurance company make you whole? Understanding what your carrier and what your policy's replacement cost definition is huge. Some carriers, it's pure replacement cost. Nothing more. Whatever's listed on the policy, that's what you get. Anything above that comes out of pocket. Others will have a percentage. Maybe it's 120% or 150%, so you're offset a little bit. High net worth carriers in most states, depending on the risk, will provide what's called guaranteed replacement costs. This means whatever the house costs to get you back to where you were before, they're going to write the check. So understanding, number one, that most insurance policies and most clients are completely underinsured when it comes to calculating that correct replacement costs is a big factor. And then number two, what is the definition of your policy's replacement cost? So if it were to cost more, I also learned from Chubb recently that over 70% of homes that have a total loss, the payout to rebuild is more than what's listed on the policy. So having that buffer is key. The other thing that high net worth carriers offer is the cash out option. So let's say the house burns down and you say, you know what? I don't want to rebuild. I have no interest in having the same house, living in the same neighborhood, having the same neighbors. I want the flexibility. The high net worth carriers in most states will allow you to take the value of the home, personal property, whatever other structures you may have, and walk away with a check. You still own the land and can do whatever you want with it, but it gives you that flexibility to be able to walk away. Where are you going to live when you can't live in your house? Having that loss of use, that additional outside living expense, to be able to choose the hotel of your choice, live in the apartment complex that you want, or maybe rent a home in the same area or school district that you're currently living in. Are you going to be restricted to a dollar amount or a time amount? Or is it a unlimited, whatever your actual loss is that has been sustained, where you get to pick your accommodations, and until you're back in the home, that's what the insurance company is going to pay for. The high net worth carriers, their biggest thing is getting you back to where you were prior to the loss and making that experience while you're experiencing the loss one that is not it's least as inconvenient as possible. We have waiver of deductibles, meaning if you have a certain type of property claim that's over a certain amount, whether it's $50,000, $100,000, depending on the state, your deductible goes away entirely. Cyber and identity theft, we're seeing this as a huge increase in these types of claims. Being reimbursed for expenses related to a breach, whether you have to hire a forensic accountant or an attorney, or maybe it's just to make you whole from the dollars that were lost due to you being tricked into giving money to someone that you thought was legit, and you've been not being able to be made whole from the bank or financial institution. Now you have an insurance policy to be able to make you whole. The high net worth carriers, they roll out all the stops when it comes to wildfire protection, hurricane coverage, whether it's having their own personal fire departments, having the ability to foam a house if they can get to it prior to the home burning down, all kinds of protections and suggestions on ways to make sure that those losses are as low as possible. And as I mentioned before, at certain levels of homes value, they're going into the house. They're scheduling those inspections to really put eyes on the home, take photos, measurements, understanding exactly what's insured, and then being able to provide the suggestions. So from a homeowner's perspective, there's so many more bells and whistles that you really don't know whether your home policy has any of these things until you take a deeper dive. This slide is just an example. The average home that we saw out in California, the loss was the $1.7 million. So this is just a hypothetical kind of throw it out there as far as an example of the replacement cost definitions and how they can be different from the different carriers. So let's say this $1.7 million home, whether it's underinsured or now because of the cost of lumber that Melissa mentioned, it's now going to cost $2.2 million to build this exact same home. So depending on the carrier and their definition of a replacement, whether it's no extension, they're on their own, a percentage extension, or guaranteed, which by the way is it's tough to have guaranteed replacement costs in California, but everywhere else in the country, this is just an example of how this can be very real, and you really just don't want to come out of pocket. And oftentimes, this is just how their policy is written. You're not paying extra for it necessarily as an added endorsement. This is how high net worth policies come standard. In addition to the home, but also usually stored in your home, are your valuable collections. So whether it's your jewelry, your art collections, wine, bourbon collections, I've seen it all in my many years. So one person's trash is absolutely someone else's treasure. Anything can be appraised by an accredited appraisal, and then you can have it insured. So I've seen sports memorabilia, I've seen Disney pins, I've seen taxidermy, I've seen all kinds of things that you can have insured for that worldwide coverage. Having that extension oftentimes to be able to give you more than what is currently appraised should the value have increased, not having any deductibles, and then also understanding, especially when it comes to jewelry, what happens from a pricing standpoint if you keep some of this jewelry in a safe or in a safety deposit box. Many of the carriers offer discounts. So if you're not wearing and you're storing it properly, there's definitely some credits to be saved. So really understanding what you have, what's valuable, what you would actually replace, and then making sure that you have the proper coverage. Most people haven't sat down and done an inventory of their current collectibles in many years. So again, taking the time to dig in and see what makes sense to insure is really important. So we've thrown a lot at you, and you're probably wondering, wow, I have no idea what I have. One of the wonderful things that we offer to Cerity Partner clients as their partner is a complimentary audit. So to be able to kind of walk through what you currently have and understand the coverages that you have, where there might be some gaps, where you might not have enough, where you might have too much, where we might look at a middle market carrier versus a high net worth carrier to understand what bells and whistles are out there that you're not taking advantage of, but also looking at the pricing and understanding where you are in the market and what could be a more competitive option. Oftentimes, it could be that we're getting more coverage for less dollars. Sometimes it's the exact same coverage for, the same dollars. Sometimes it's increased coverage for the same dollars, and other times it is more. But once you see the investment, it's up to you then to decide whether or not you want to make a change. The complimentary audit is not a sales pitch. It is truly educational. So if you want to take the learnings that you receive from our team and go back to your current agent and fill those gaps, that's great too. This is just truly a value add of being a Cerity Partners client.
Thank you, Michelle, Elise, and Melissa, for your truly comprehensive overview of the insurance market and the nuances of what's going on as it relates to our clients' coverage. Couple of questions for you as follow-up items to the great presentation. Michelle, I'll start with you. We touched on, I think, the benefits of getting an audit, of reviewing all your coverage, no matter what it is, for a lot of clients, that's an overwhelming process of where do I start with that? So what are the things that a client would need in terms of documents or existing policies to complete the review? And secondly, what's the expected turnaround time to get back with an analysis of their current coverage?
Yeah, no, great questions. So we try to make it as least painless as possible. We typically schedule a call to kind of understand the makeup of your current situation. We would need copies of your current policy declaration pages. So not all 100 pages, but just those first few that are summaries of what coverages you have. We also would need the information regarding the occupations, driver's license numbers, birth dates of all household drivers. And then through that discovery call, that initial intake call, we really understand the dynamics and the makeup, whether there's children away at school or adult children still on the policy, if you have rental properties, if there are multiple homes, if there's land that you own, if there's boats, ATVs, jet skis, vacation rental properties. There's so much that a client might not realize necessarily falls under the full umbrella, no pun intended. We also talk about umbrella to make sure that they have what they need. So it really is just a half-hour phone call and then sending over policies, and then we kind of take it from there. The typical turnaround, I would say, depending on how complex the account is and how fast we can get all of the information, is usually between 7 to 10 business days. And then once we have that audit, we schedule a time to sit down. The advisor can join if they'd like, and we kind of walk through and do a full educational comparison of what they have compared to what we found in the market.
Great. Elise and Melissa, you touched on all the events and catastrophes that happened in 2024 and obviously the wildfires in the greater LA area. For a lot of our California clients, they're asking, what is the current state of the insurance market within California? Can you provide your perspective?
So, Tom, that's a great question. And I really wish I probably had a better answer for you and your clients. Unfortunately, I feel in the real near future that it's still going to be a challenging place for people to secure homeowners coverage. And as Melissa or Michelle talked about, it's really going to be probably more of an ENS solution, especially for those more significant homes. What we do hope, in light of the fires, that potential changes, hopefully sooner than later, would be, that the state of California does look at wildfire mitigation differently. And then also the California Insurance Department would really, be open to sitting down and working with insurance carriers to really work together to find a way, that a carrier can provide a solution at appropriate premiums and appropriate coverages.
As a follow-up question, I know a lot of our clients who are not in California residents are thinking about in my state, whether that be Colorado or certainly clients in Florida have experienced this. What are the proactive steps that their states or the insurance market is potentially taking ahead of a catastrophic event in their state? Are you seeing any trends outside of California that you think are worth highlighting?
I mean, I think the one trend we're seeing that a carrier can take is really around loss prevention. So, I mean, there are many times if we go out and see a home and it has a wood roof, we are asking them to replace that. We are asking them to do ember resistive vents, which is if the embers are blowing over, if they land on those vents, less chance of the home catching on fire. To really make sure that the landscaping that they had, it's not like we're saying you can't have any landscaping. We're just asking that the landscaping you have cannot generate as much fuel. Because really the greatest risk is sometimes not the fire itself, it's that the embers can travel for like 3 miles in the air. And if they land, like if you had wood furniture or something right by your home and the embers landed on that and caught that on fire, then it can catch your home on fire. So it's really from an insurance carrier perspective right now, it's really trying to work with individuals to better protect their home as well as they can.
Yeah, I would just chime in here that we had a client in Park City that had an HOA that said, what can we do to help our neighborhood? And we actually connected them with a high net worth carrier, with the HOA community to say, okay, how long would it take for the fire truck to get here? And when they understood the timing of it, they basically worked with the carrier to get them comfortable of basically building almost like a mini fire department very close by to where the community was. And it helped create comfortability from the carrier with that specific community. So there are ways to kind of increase that communication and provide that risk protection. And then as far as Florida is concerned, I would say that, what we're hearing from the carriers is that if it's a newer construction, the construction, Florida understands their risk when it comes to newer construction. So if it's a larger home and they're using the right products to build the home, we're seeing that these homes are standing up to these storms pretty well. And because of the market, people who buy larger houses in Florida and newer houses in Florida, they understand what the price tag is per se right now in Florida. So the kind of the awareness of the market and the pricing of the market have kind of leveled out to understand what's going on. And because the houses are built so strong, they're able to kind of withstand. So for clients that are thinking about moving to some of these more challenging states, to understand first the makeup and the construction and the potential of what the house that they're looking at multiple homes, to have insurance be a factor in their home decision is smart, but also to understand whether it's an HOA or a community or what the fire protection situation is around them, as well as just understanding kind of what the trends are in those neighborhoods. I had a client the other day who said he's moving from Park City to go to California. And I said, well, it's not going to get any better. So it's a matter of really doing your homework, finding a trusted resource that can do that homework for you so that you're not blindsided when you walk into a situation, whether it's a non-renewal and you've had the same carrier for, decades, or you're thinking about purchasing something new, so that you have a clear understanding of not just how much it's going to cost, but why it's going to cost that much. And having that partner to be your advocate and help translate is really important.
So one last question. You touched on the replacement costs and the importance of understanding your carrier's coverage options in the event of needing to rebuild or replace a home. With the recent increase in tariffs putting pressure on building costs and in general just cost of input into a house, are you seeing any trends within the insurance industry of how those costs may impact either coverage or the cost of insurance?
Well, it's interesting because Chubb actually publishes their industry trends reports every year and every quarter, actually, right? And things were starting to level off as far as inflation goes, as far as the actual costs of goods to rebuild the lumber and the drywall, as Melissa was talking about. So now with the tariffs, I think it's kind of a wait and see in this moment, but the insurance companies are very aware of it and trying to, project what this could mean. I think we're still a few months away from understanding exactly what pricing implications would be. I read an article this morning that said perhaps it's a good time to shop now before the tariff implications actually land, so that you at least know that you're getting as low as possible prior to the implications of the tariffs kind of hitting. So if you haven't shopped it in a while, maybe now is a good time to just understand where you are baseline before everything hits.
I want to thank our great speakers today, Elise, Melissa, and Michelle, for their tremendous insights into the insurance market and how our clients can think about their current coverage and maybe future coverage. For all our clients or potential clients, please reach out to a Cerity Partners advisor if you'd like to learn more about the risk management techniques and strategies that we can help you implement within the course of your financial plan, and happy to put you in touch with Michelle and the team to do a audit of your current risk management policies. Thank you so much, and please visit our website at seriapartners.com.